Hello everyone. Today, me and my group members will present PETRONAS Chemicals Group BERHAD PCG Financial Evaluation. Our team consists of me, Ongin En, Lojusine, Chesini, Chongming and Danny Wei. Now I will present the company profile, context and key highlights of PCG. PCG was established in 1998 and is listed on the main market of Bursa Malaysia under stock code 5183. It is one of Southeast Asia's largest integrated chemical producers and a subsidiary of PETRONAS. The company operates across the petrochemical value chain and produces olefins, fertilizers, methanol, and specialty chemicals. These products serve a wide range of industries, including agriculture, automotive, construction, packaging, pharmaceuticals, and consumer goods. One of PCG's biggest strengths is its integrated business model. Through PETRONAS, the company enjoys stable feedstock supply and strong infrastructure support. Today, PCG operates 19 manufacturing sites worldwide and serves customers in more than 80 countries. Moving on to the industry context, the period from 2021 to 2025 was highly challenging for the global chemical industry. In 2021 and 2022, the post-pandemic economic recovery boosted demand and improved selling prices. However, supply chain disruptions and the Russia-Ukraine conflict caused energy and raw material costs to increase significantly. In 2023 and 2024, higher interest rates, weaker global growth, and lower demand from China and Europe reduced industry profitability. At the same time, the depreciation of the Malaysian ringgit increased operating costs. By 2025, PCG faced even greater challenges, including global oversupply, asset impairments, and foreign exchange losses, resulting in a loss after tax of 2.1 billion ringgit Malaysia. To respond to these challenges, PCG expanded into specialty chemicals, improved operational efficiency, strengthened cost management, and invested in sustainability and ESG initiatives. Although earnings declined after the strong post-pandemic years, the company's diversified product portfolio, strong liquidity position, and support from PETRONAS helped it remain financially resilient. That's all from me. Thank you.
Now, I will be talking about the financial performance analysis for PCG BERHAD. Here, we have a complete ratio analysis of PCG BERHAD from year 2021 to 2025. This table here states all the ratios of liquidity ratio, activity ratio, and debt ratio. And this table here states all the ratios for profitability ratio and market ratio. Liquidity ratio. Liquidity position deteriorated sharply over this period, tightening consecutively every year from a current ratio of 4.33 in 2021 down to 1.44 in 2025. This downward trend also reflected into quick ratio signals, a reduced buffer against short-term obligations, and increased reliance on inventory. Next, activity ratio. PCG is managing its inventory levels with consistent timing, maintaining an inventory turnover ratio between 5.85 and 6.52 turns. Total asset turnover was steady, moving narrowly between 0.47 and 0.52 from 2021 to 2025. Debt ratio. Leverage continuously marched upward over the last 4 years. The debt ratio increased from 0.24 to 0.35, and the debt to equity ratio rose from 0.32 to 0.56. Indicates that management actively took on long-term debt and leverage to aggressively fund new capital. The times interest earned ratio plumped from an exceptionally secure 241.72 down to a negative 3.97 in 2025. Profitability ratio. PCG's gross profit margins plunged from 37.26% to 10.6% by 2025. Operating margins fell to negative 4.99% and net profit margins turned negative at negative 7.79% by 2025. Return on total assets fell from 15.81% to negative 3.71% over the period. These shifting metrics reveal that the company moved from a highly lucrative peak into a severe net accounting loss by 2025. Market ratio. PCG's POE ratio rose from 9.71 to 35.20 as earnings collapsed, culminating in a negative multiple of negative 13.56 in 2025. The market output ratio dropped from 2.05 in 2021 down to 0.81 in 2025. This sub-negative 1 ratio indicates that equity investors are discounting the firm's balance sheet value, treating the company's heavy fixed assets as a liability. Overall, PCG's financial position transitioned from a peak cycle performance into a heavily compressed cyclical bottom by the conclusion of the 5-year timeline. While the accounting metrics show negative values for profitability and market returns in the final years, these losses are normal and do not signal operational failure. These negative values are heavily distorted by non-cash accounting items like depreciation, amortization, and asset write-downs.
Hi everyone, I'm Danny Wei and I'm here to explain about the cost of capital evaluation. So let's move on to our capital structure and market risk analysis for PETRONAS Chemical Group. If you look at the weighted average cost of capital or WACC from 2021 years to 2025, we see a fascinating story of macroeconomic pressure followed by a brilliant strategic optimization. In 2022 years, WACC peaked at 7.53%. It was heavily driven by global inflation and monetary tightening, which forced the Malaysian risk-free rate up to 3.90%. sending our cost of equity to a peak of 7.09%. Because our PCG capital structure was heavily reliant on equity, is nearly 94%, this macroeconomy shift directly pushed our overall cost of capital. However, look at what happened from 2025 onward. Management actively optimized the capital structure by aggressively leveraging cheaper debt, nearly doubling the weight of debt from 8.22% to 15 and 80% by 2025 years. Even though interest rates were rising globally, this deliberate shift to low-cost debt successfully insulated the company, and also optimizing and driving our final ROACC down to an efficient 7.46% by 2025 years. So, let's move on to the security market line analysis. This exact macroeconomic journey is beautifully visualized on our security market line graph. With a stable institutional beta of 0.8, PCG remained 20% less violent than the broader market due to strong backing from PETRONAS and robust long-term contract. The SML shift upward from its pandemic low in 2021 to peak in 2022 due to the global inflationary shock. It then slightly flattened before climbing up in 2024 and 2025 years. It's tracking domestic shift like Malaysia's subsidy rationalization and also long-term inflation premium. So let's move on to the conclusion. Ultimately, our SML analysis is revealed that PCG equity is overvalued. While risk profile demand is 7.90%, it is high rate. Its actual return has plummeted to negative 5.95%. It's meaning that investors are heavily overpaying for the underperformance for PCG. And this is triggers several implications. At the first point, a major capital loss risk lies ahead as the stock price inevitably corrects downward. And for the second, this negative return actively destroys shareholder wealth instead of compounding it. And also, the final one is do not let the low beta of 0.8 fool you. And this is a classic value trap. Low volatility may slow the decline, but it cannot protect investors from falling operational realities. Thank you.
Having evaluated the company's financial health and its position in the market, our group has reached a consensus on the investment outlook for PETRONAS Chemicals Group. Our formal recommendation is a hold. I understand that the word hold might sound cautious given the recent financial headlines. We have seen significant impairment charges and a contraction in net margins that will typically trigger a sell rating. However, we believe that offloading this position now will be premature, and here is why. First, we must respect the nature of the industry. Petrochemical cycles are inherently volatile. They are high beta assets that respond sharply to global demand. We are currently observing early, subtle indicators that the sector is nearing a cyclical bottom. For instance, recent sensitivity in euro prices to West Asia geopolitical tensions suggest that the market may be turning a corner. Second, and the most importantly, is the company defensive strength. PCG is not facing a liquidity crisis, with a cash balance of approximately $9.6 billion at the end of 2025, the firm possesses a massive financial buffer. The liquidity allows management to fund essential maintenance and navigate the challenging 2026 outlook without resorting to desperate, value-destroying fire sales of assets. Finally, consider the board dividend policy. By choosing to maintain dividend distributions despite reporting a net loss, management is sending a powerful deliberate signal. They are signaling that they have high confidence in a long-term cash flow recovery. For us as analysts, this signals stability, which is exactly why institutional investors continue to hold the line. We believe the current market price has already priced in the worst-case scenario, and the whole strategy provides the best balance of risk and potential reward. This is all for me now. Thank you.
Although we recommend a hold, but this is not a passive strategy. It is a disciplined plan that requires active monitoring. For value investors, we suggest treating the current price as a bottoming zone. However, do not buy more shares yet. We recommend a wait-and-see approach. We are looking for two clear signs before changing our rating to buy. Firstly, the return to positive operating cash flow, and secondly, the successful restart of Pengerang petrochemical operations. These are the green lights that you may need before increasing your investments. For those who managing risk, you must also be disciplined. We suggest two stop-loss triggers. Firstly, if the cash-to-debt ratios get significantly worse, or if the plant utilization stays below 85% for 2 consecutive quarters, it is the time to exit. These indicators will tell us if the company's problems is becoming structural instead of temporary. To conclude, PCG is facing a lot of pressure, but its strong cash reserves and commitment to the dividends provide a solid foundation for survival. We believe the company has the resilience to get through this difficult period, and we have enjoyed analyzing these financial results and hope this report provide a clear roadmap for PCG. Thank you for listening. That's all from our group. Thank you.